Hi Level Up community, this is Lee Dahan, and I'm here to share to you what I learned from the second learning course, which is about incentive stock options, strike price equals fair market value. Basically, in this course, I was able to be refreshed about these terms, which are common when we talk about ISOs. First we have is the grant date, which is when the ISOs are granted to the employee or the client. Second is the number of shares awarded. Third is the grant or the strike price, which is the price per share that the ISO owner would pay at the time of exercise or purchase. And lastly is the vesting schedule, which provides when and how much of the shares are exercisable. Now, to elaborate more of my learning, let's put ourselves in a situation where I'm discussing to you this topic as my client. Hi, I'm very much happy to have this meeting with you, and I understand that you have been granted incentive stock options by your employer, and I've placed the information that you have provided me here for our reference. You have here the grant date of February 1st, 2024, with a total of 100,000 shares granted for a strike price of $2, and also the following vesting period as follows. So based on this information, it shows that you may start exercising the stock options beginning next year in February. By exercising stock options, I mean that you have the opportunity to buy the company shares up to the number of shares vested at that date. So let's say, for example, next year you have up to 25,000 available shares to buy. Actually it's good that we have this tax planning so that you will know what things you should be considering before you buy the shares or you exercise your ISOs. And I believe number one of which is that you have to consider is your budget, because buying shares entail a cash outlay. And as early as now, you can try to assess how much are you willing to spend to get these shares, depending also on your risk appetite. Now, you already know that your ISOs have a grant price of $2, right? So this is the same price that you're going to pay for each share at purchase date. Let's say, for example, you want to exercise all the 25,000 shares available at vesting. So it will cost you around $50,000 to buy the shares at this strike price of $2. Another thing that you have to consider is that when the vesting period comes, we also have to take note how much is the fair market value of the shares. You know why? Because this will determine the taxability of the purchase transaction. If, say, upon vesting period, we've been so lucky that the fair market value happens to be equal to your $2 strike price, then there will be no taxes that will arise once you exercise your stock options. Meaning, there is no ordinary income tax when you exercise or when you hold these shares, and there is no AMT also because there is no delta between your strike price and the fair market value. Now here's another thing. Since there are no taxes expected out of this transaction, it follows that there will also be nothing to report in your 2025 tax return about you buying the shares, right? But if you sell the shares within the same year, 2025, it's another thing. So we might need some reporting to do in your return next year with respect to any gains you earn from the sale. So that's why it's important for us to track the basis, which is the $2 per share, and also the date of purchase to determine if you qualify for the short-term or long-term capital gains. Because these information will become handy later on once we calculate your taxes when you decide to sell them. So feel free to let me know if you have any questions regarding this. Now, to complete the picture, let's go over to what's going to happen when you sell your ISOs, specifically in a situation when the strike price and the fair market value is the same at exercise date. Let's say, for example, you plan to sell the shares for $25 on the 8th year. The first thing we need to consider is the expected total gain to report on Schedule D of your return. So since your selling price is higher than your strike price, it means that you have a gain equal to the difference of $25 and $2, which is $23. Essentially, it's going to be treated as short term if you sell the shares within a year from the date of exercise. But since we kept track of the date of purchase, we get to determine from the facts that we sell them more than a year, so your expected gains will be classified as long-term gains. Now, aside from the tax reporting aspect in the return, it's always good to pre-plan the sales, so we could also avail any possible tax strategies for us to be able to possibly do away or legally avoid the tax. And that means possible savings for you in the future, right? And in this type of transaction, we can check for you if we can have avail of treating this as a qualified small business stock, or it could be an opportunity zone wherein you may opt to reinvest the funds that you're going to get from the sale to defer your taxes. So these are good tax strategies that we can explore later on. Another important tip that I could give you to be conservative is by making estimated tax payments to avoid penalties. So as your tax consultant, I can run a calculation for you about this to check if there's a need to prepay when you sell your shares. Now, other than the calculation, we can also assist you in making sure that we have properly reported the gains related to the sale of shares. So just feel free to let us know regarding about your plans. So the earlier we get to talk about these plans, the better you could avoid any surprises in terms of your tax liabilities upon upcoming filing season. Thank you. And that's it for the second course. Thank you so much for watching, and see you in my next video.